if you think about it, if you're married filing jointly, you can lose a standard deduction and your tax tables will shrink. So on your surviving spouse, they're inheriting a tax bomb.
Welcome to the show. I'm Michael Johnston. Joining me today is Amar Shah. Amar is the founder and the CIO of Client First Capital. Amar, thanks for joining me today.
Thanks for having me.
So I want to dive right in here. I want to start with the way that you describe your approach to wealth management. Just reading from your website here, you describe it yourself as being at the intersection of investments, taxes, and estate planning. Can you explain what you mean by that? I think it's a great way to kind of summarize a more holistic approach to financial planning and wealth management.
Yeah, we follow the Doug Lennox intelligent advisor model, and essentially the investments, taxes, estate planning, and also risk planning are the core of the wealth planning that we work on. But we tie that with values and family dynamics. But really, this is the wealth planning component. And the wealth planning component tied in with your values really determines your legacy. And the wealth planning component tied in with your family dynamics really creates harmony within the family. And one of the other benefits, multi-generational planning and impact on community. So when we look at wealth planning, investments and taxes, they go hand in hand. We're looking at after-tax return, right? And then when we're looking at estate planning with investments, part of that is what is your cost basis, right? And how do we transfer some of those gains onto generation 2 and 3 of their balance sheets rather than it being on your balance sheet? So really the intersection of those are things that are most important to people in the second third of their life, where they're looking at how do I maximize my wealth? How do I do legacy planning? And those three, just where they intersect, is where there's a lot of advice opportunity.
Yeah, agreed. I think that visual you presented is a great summary. So let's kind of tackle the pieces of that one by one. Let's talk about taxes first. I mean, this is you're speaking my language here. I love talking about tax efficient investing. You said essentially what matters is what you keep, right? Like after taxes. And I think a lot of people don't realize this, but taxes are essentially their biggest expense in life, right? Like it's not the mortgage on your home or your car payment or your grocery bill. Taxes are your biggest expense in life. And there are a lot of legal and even encouraged ways that investors and individuals can reduce their lifetime tax bill. So, without getting into kind of talking more broadly, getting into too much specifics, what are some of the strategies that are kind of in your go-to or in your playbook that you're able to add value for clients who maybe aren't thinking about taxes that way, and maybe you're able to kind of turn that light bulb on for them or help them have that aha moment and realize the importance of their taxes on ultimately what they're able to keep or what they're able to transfer?
That's great. You can think of just 3 examples off the top of my head here that made me illustrate the broader conversation of why taxes are important. So the first thing I would say is asset location, right? So most people have their taxable account, their IRA or 401k, and maybe they have a small Roth IRA, right? And so kind of looking at within those 3 buckets, what assets do you want to hold where, right? So if you're looking at a portfolio holistically, you're not going to own the same things in each one of those accounts, right? So typically your transactional type investments would be in your IRA, because you're not paying ordinary income on short-term capital gains or interest income on bonds, right? For example, your buy and hold securities. I would argue in almost every single model that people invest in, there's a sleeve that is large cap. That sleeve that's large cap most of the time is essentially the S&P 500, right? So you could buy the S&P 500 index, buy and hold in a taxable account, and you have more favorable treatment for long-term capital gains and whatnot. So example 1 is just where do you own what you own, right? Example number 2 is just in your income taxes that you have. There are going to be events where you're going to have to itemize, and then there are going to be events that your standard deduction for a majority of the time. And what the Tax Cuts and Jobs Act have done is made the standard deduction so high that almost a majority of people in retirement will be using standard deduction, right?
Mm-hmm.
So how do we plan around this? Well, there's three parts to this. There's the modified adjusted gross income. There is your charitable contributions, and there is your IRMA for Medicare, right? So ideally, what we want to do is every year create these buckets. And on these buckets, what we have is what is the most, where's your current income and where's the next tax bracket? And in between that, where is the next IRMA threshold, right? And so we want to kind of take advantage of doing Roth conversions to be at the upper end of the lower tax bracket, so to speak, right?
Right.
Or upper end of the lower IRMA threshold. And the advantage of this is that you can delay your Medicare's IRMA increases to later in life, right? Also, with the Roth conversions, if you really look at the biggest tax bill that a family will have is really when one spouse passes away, right? Or for those single individuals out there that they're already in a not so favorable tax situation. So if you think about it, if you're married filing jointly, you can lose a standard deduction and your tax tables will shrink. So on your surviving spouse, they're inheriting a tax bomb, right? And so some of these Roth conversions, when we look at the calculators that you find online, they're only looking at it as when do you break even and when do you get ahead, right? But they're not looking at it from the whole time spectrum of your dollars. How do we save the most amount in taxes? So the second option there is really looking at Roth conversions and reducing your overall tax burden from that standpoint. The third option, and there's many examples that I have, but I think I'll just go with the theme here. We talked about married couples, and we said single individuals have it the hardest. Single individuals are also the ones that are, at the end of life, are pretty much the most charitable. In terms of what we found is that nieces and nephews may get some dollars, but a significant amount of these dollars will be going to charities. And beyond doing a QCD and all that from IRA accounts, the one thing that becomes a greater concern is that if we're distributing these assets at the end of life, how do I get some of that tax benefit now while I'm alive, where it impacts my income taxes rather than my overall estate, right? And so one of the things that we can look to is charitable remainder trust. We can look to, even when you're rebalancing, taking a stock that has high capital gains, transferring that to a donor advised fund so you can itemize this year and buying that same stock if you like that company to just increase the cost basis, right? So, there are many ways that taxes affect one's retirement experience. Taxes are the largest expense in retirement. And so managing that through proactive planning is what helps clients get ahead. Yeah. So I don't know if I answered your question originally. I think it was on tax sensitive investing, but I think we look at taxes more holistically.
Yeah, no, and I think, if I were to kind of pare back what I just took away from what you said, a lot of people, they spend a lot of time thinking about how do I get the most money possible into tax advantage accounts? How do I do a backdoor Roth? How do I max out my 401k? So they think a lot about how to get money into these accounts. You also spend a lot of time, it sounds like, thinking about helping clients think about, well, how do you get money out of these accounts? That's actually kind of that's ultimately what you can spend in retirement is how do you do these smart withdrawals so that you, as you said, you can kind of go up to the top of a marginal tax rate. But how do you set yourself up for success? And, for some people are fortunate that accumulating assets is relatively easy. Deaccumulation or kind of withdrawing from those accounts in retirement can be pretty darn complicated, right? And I think a lot of people don't appreciate that. You talked about asset location and just some of the different nuances of withdrawal strategies.
Yeah, Michael, I'll just give you an analogy. I'm an endurance athlete, so I like to go in the mountains, run and stuff like that, triathlons, rock climbing, etc. When you're climbing a mountain, brute force going uphill, it just takes brute force. There's no technical skill involved, right? And for most business owners, corporate executives that are really good at their job, saving money is an equation of just brute force. When you're coming down the mountain, and you got to watch where you're stepping. If you step right, there's a rock. If you step onto the left, there's a sand pit that's a little bit slippery, right? That's where more technical skills become involved. And you want to save your knees when you're going down a mountain, right? But just like the same way you want to save your nest egg on the way that you're spending, right? And so really setting up the right structure has probably a larger impact than just brute force of just withdrawals, right? So
Yeah. I love that analogy. I'm not an endurance athlete like you are, running these crazy races up and down mountains, but everyone's run down a hill, and you appreciate that it's in some ways it's harder than going up, or at least there's more potential pitfalls along the way.
yeah,
So I love that analogy. I'm going to take that, but I will
there
give
you
you
go.
credit. So let's talk about the kind of the second piece of that you alluded to a couple times of multi-generational or passing on assets, transferring wealth. I view there as kind of a couple of ways that this can go wrong. One is, I guess, more quantitative in that you end up paying way more taxes than maybe you could have if you'd done things correctly. But the second, which in my mind is potentially more devastating, is you pass on assets in such a way that, just to be blunt, that the next generation hates each other, or they're at each other's throats, right? Or you cause these conflicts, and there's all these stats about how quickly the second and third generation lose wealth that's passed on to them. So am I thinking about that the way that you do, that there's kind of a quantitative and then a softer, more qualitative way for advisors to help their clients talk through their estate strategy or their giving strategy?
Yeah, absolutely. This is a great question, Michael, and it's part of the reason why I got in the industry. My background's electrical engineering, computer science.
Hmm.
Coming into a financial advisor role, I was kind of like Dilbert, right? Pretty square, didn't really kind of make the dots connect. But one thing that I really enjoyed in this profession is really getting to know clients and what they want to accomplish and why they want to accomplish it, and kind of just peeling those layers back to finding out what would work for them and what would be totally devastating.
Hmm.
And through my career since 2004, I found that individuals that have more than enough wealth for their needs is not so much about the money, but about their family and generation two and generation three. And kind of seeing those layers of impact gives a new definition to what family actually is. When we're doing estate planning and when we're looking at planning for multiple generations, what we do not want to do is have a situation that we're trying to maximize the tax benefits to
Hmm.
save money, but then incur unintended consequences with our children and grandchildren that totally negate the impact that those dollars were supposed to have. So when we're doing planning, I think there's three things to be cognizant of. Number one is what are the unintended consequences? So I'll give you a good example, Michael. We're coming up to the sunset of the Tax Cuts and Jobs Act,
Yeah.
right? And people with a lot of wealth, they're tax professionals, estate planning professionals, and even financial advisors are telling them that, hey, you should gift, the maximum amount now to your children or into a spousal trust, a SLAT or something like that, because these exemption amounts may go down and you're not going to be able to take advantage of it, right? I mean, if you get somebody that's making $100,000 and you put $10 million into a trust for them and you have to distribute income, you're like 4xing their gross annual income, right?
Yeah.
That can create a lot of unintended consequences. And so the first thing there is just, the best financial solution may not be the right answer for your family, right?
Hmm.
So that's one thing that I would tap into is probably the most important. The second is that we have to work on the sphere of influence on generation two and three. It's probably more important than the actual dollars that generation two and three have in their estate planning vehicles. It is, you hear the story over and over again that somebody gifted their children X amount of money to buy a house. they didn't set it up correctly or whatnot, then that child is going to go potentially going through a divorce, and that house is being subject to being part of that divorce, right? Or
Mm-hmm.
you get the story that, the child, we started doing the annual gifting, and now we've done irrevocable trust, and my child was working, gainfully employed, and had a good career, and now is just hanging out at home playing video games, right? So you got to tie some incentives to what you're looking to accomplish, right? This could be as simple as like a savings goal, like, hey, do a family meeting, have the communication of like, planning is important, savings is important. The bank of mom and dad is going to match your savings, your W-2 savings, your business savings, whatever you want it to call, but so that there's some incentive, right? So the second point that I'm trying to make is that this working on the sphere of influence is equally as important as the dollars, right?
Sure.
And then the last thing is like, you know, we want to make these documents flexible. We want to make these documents broad enough where there is some flexibility. And I can tell you that while you're in the moment of making these documents, that the mindset may be to be more restrictive, but then 10, 15 years down the road, you may not be able to undo those restrictions, or you may have passed and now those are set in stone for your children, and they don't have the flexibility that they need, right? So, when we look at these documents, one of the things that we're looking at is the language, right? And is that language super restrictive? So just a basic example, in most trusts, it says that all income must be paid to the beneficiary, right? Well, I know why they set that up is because if the income stays in the trust, it's taxed at the highest tax rate at 13,000.
Mm-hmm.
But you could have a situation where your child is a doctor, is married to another doctor, they're already in the highest tax bracket. So it doesn't matter if that money stays in the trust or is paid out from a tax perspective. But for your child, if those assets stay in the trust, it provides a lot more protection for those assets within the trust, because technically that's not their money, right? So,
Right.
so those would be my three things. I don't know if I'm going overboard here, but really it's just go ahead.
Yeah, no, I think that's a great summary, and I think that there's a huge spectrum there, right? And there's a lot of options of what that looks like. I was just talking with someone the other day, and he's one of 10 kids, and he said that his parents set up a trust, and what it does is it funds a family reunion every 2 years, and that's what his parents wanted, and he said it's been incredible. Like every 2 years they get together. This year, I think he said they had like 90 or almost 100 people, and they get together close to Denver, usually someplace centrally located. And it's this incredible family event. And he's been able to keep in touch and grow relationships with not only his brothers and sisters, but the extended family as it's grown. And I never heard of that before. But for this family, it was the perfect thing, right? And that's not going to be the perfect thing for a lot of families, but kind of highlights, I guess, the importance of actually getting to know people and actually understanding what their motivations are. And I like that term, the sphere of influence as well.
Yeah. Yeah, no, I agree. I mean, there are a lot of creative things that I've heard clients want to do in their trust, and for some it works, and for some, there could be unintended consequences.
Yeah. So I want to ask you, we've talked about taxes, we've talked about estate planning. I want to kind of ask you how you view your role as a financial advisor. I'm guessing that you're not signing tax returns. You're not the lawyer who's drawing up these estate planning documents, but yet you've got to interface with these other service providers. Do you view yourself as like the quarterback, or are you the point guard, or maybe that's not a good analogy here, but
Yeah.
it's kind of can be a delicate process managing these folks who have potentially different incentives and different inputs. But how do you think about adding that value, I guess, indirectly for your clients, even if you're not the one who's drawing up the contract, but you're kind of coordinating the process?
Yeah. Yeah, I mean, that's a great question. And I know a lot of advisors are like the quarterback of their financial situation for their clients and stuff like that. We kind of operate kind of like a family office in that
Mm,
standpoint. So we have resources here to work with clients as well as we work with their CPAs and estate planners. And really, the biggest way that I describe it that I found um, that resonates with our clients is that we're simply to be a sounding board to make better financial decisions, right? You know, we're the third
mm,
party that can see your picture as well as 1,000 other clients that are in similar situations over the last 20 years and what they're facing to see what you're going to potentially face and what bottlenecks you'll have. So um, we are a sounding board to make better financial decisions. And one thing that I've noticed is that when we're working on a multi-generational basis, you know, we have one client where we're working with 4 generations. We were at one point. Now it's down to 3. But it is something that you need to be able to resonate with generation 1,
hmm
2, and 3, right? And sometimes I kind of find that we're like Goldilocks, right? Because we're young enough to understand the methods of communication of text messaging and memes and whatnot, and we also get that clients like paper statements, right?
Sure.
So there's a wide spectrum in terms of connecting with clients,
Yeah.
and so yeah, I think how I describe what we do is we're just simply a sounding board for you to make better financial decisions.
You're the sounding board. Great. So I got two more questions for you here. One, I'm curious. You mentioned you're an electrical engineer. So how does an electrical engineer end up as a financial advisor?
Yeah, yeah, this is a funny story. Yeah, so you know, back in the day when cars would reverse, there was no reversing camera. There was,
Yeah.
uh, we were developing the sensors for BMW on when cars back up, and it would make that beeping noise, like beep 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 beep.
Yep.
Got closer. Um, so that's how I got my education in electrical engineering and computer science, specifically RF design. I worked for Qualcomm, which is a San Diego-based company. And then my job got outsourced to India, and I'm Indian, so it's kind of ironic, right? It's like, and my college buddy was a manager at American Express Financial Advisors, and little did I know is I was entering a sales role, right? I thought, oh, I'll be analyzing portfolios, making recommendations on what asset classes to buy and sell, and it turned out to be a real sales role. And I struggled, I got better. Then I went to work on Wall Street, so I was in New York for a while for JP Morgan, and then going full circle, my job not getting outsourced, but was becoming digitalized, meaning, we were going to a Zoom-based environment, right?
hmm
And the clients that I were working with at that time, our average age is, in the mid 70s. So um, they prefer working face to face. And then I decided to kind of start my own firm at that point.
Yeah, that's a great story. My dad's an electrical engineer. He's not a financial advisor, but I can appreciate how the way that an electrical engineer's mind works translates to kind of this very analytical, data-driven.
Very analytical and thought process. Yeah, it's kind
Yeah,
of, I view this job as problem solving 2.0, right? Where it's like, for as an engineer, it's kind of black and white, right? This is the
sure.
problem, and then this is the best code, the least, the best solution, right? Whereas in financial planning is you can have the best solution, but if a client is not comfortable or doesn't feel like implementing or doesn't feel safe in that recommendation, then you haven't gotten the client to where they need to be, right? And
Sure.
so financial advising is partially finding the best answer that your clients will implement to get them closer to their goals.
Yeah, that's right. As you mentioned earlier, sometimes you're not only optimizing for the smallest tax bill, but you're optimizing for, well, what's most appropriate for the family is going to check those harder to quantify boxes to make sure that everyone is being set up for future success. Okay, my last question for you, Mar, is where can folks go if they want to learn more about you and more about your firm?
Yeah, I think that the easiest place to go is just clientfirstcap.com, right, which is our website. On the bottom, it has our phone number, and you can just give us a call. That's the easiest way to get in contact. We also have a YouTube channel. It's called Client First Capital Learning, and we take conversation topics and we just post them online. And it's a way for people to kind of see kind of the depth of work that we do.
Perfect. We will make sure that all of those links are in the show notes for this episode. Amar, thanks so much for coming on. This was a great conversation. I appreciate
Yeah,
your insights. Appreciate your time.
thank you for having me.